Thank you again, everyone, for joining live. If you're listening to this on replay, then thanks for taking the time to listen to the recording. Today, we have a very special guest, Aditya Ravi from Rystad Energy. He's one of the top global analysts that is at Rystad looking at global energy markets. So very excited to have you today. Sir, thank you so much for joining us. Before we jump into a conversation, I wanted to hit a couple of housekeeping items. You may have seen that we released a small additional bit of allocation for Wildlight. That is nearly full already. So if you are interested in grabbing some last minute allocation on that, there's a little bit more information on that email that we just sent out on the Wildlight deal. We are in active evaluation for the next development deal with BLDG and Fellowship. We're super excited about the potential for a follow-on opportunity in partnership with them. But this is kind of a nice opportunity for people to jump in to a project that's already broken ground, just a much more accelerated timeline than that next project. So Mark is not able to join us today, but we have 3 wells that we have purchased down in the Haynesville with Comstock. Those just went into the portfolio. We have another 7 that we just wired off funds today for, which we're really excited about, that are going to be some refracs. But with that, TJ, Noel, am I missing any housekeeping items before we jump into a broader discussion on the energy markets?
Excited.
TJ's giving me the thumbs up. All right, sounds good. Well, with that, Aditya, thank you so much for joining us. We'd love to hear a little bit more about your background, and I think investors are going to have a lot of questions. So, Noel, if you could just make sure that the chat works and that it's open for everybody, because I'm sure there's going to be some questions jumping in there. Aditya, nice to see you.
Yes, thanks a lot, Tait. Yeah, for anybody who hasn't heard about Rystad, Rystad is a energy advisor / data partners for several international, domestic, independents, ENPs. We started off in 2004 as a spin-off. Some of our founders came from McKinsey, and we started with oil and gas, but of course we evolved into covering the broader energy theme. My name is Aditya Ravi. I'm a petroleum engineer by background. I also have a background in petroleum economics. I've been part of Rystad Energy for a decade and a half, slightly more than that, majorly focused on upstream oil and gas for the entirety of my time here. So that's pretty much my background. I started off as a researcher focused on Australian market, but then eventually moved on to covering African markets and then LATAM. I moved to Houston a few years ago. This is where I'm based and sort of a lead analyst for the Americas, but also now stepping into a more corporate role very soon. In a month's time, I'll be relocating to our headquarters to lead our upstream solutions. So yeah, that's my background.
Excellent. Well, thank you so much. We have a large oil and gas fund that we run, and a lot of the folks on the call today are investors in that fund. And obviously with the geopolitical turmoil that is currently occurring, it's funny, we had your colleague Schreiner Parker on, I believe it was back in February or March, and the story back then was Venezuela, and there was a lot of concern that the additional capacity from Venezuela was going to dump in to the global market and depress energy prices. And Schreiner was able to come on and really assuage those concerns. And I think today it's a little long overdue at this point to have a conversation about what's happening in Iran and the Strait of Hormuz, and how this may affect energy prices going forward. When you look at the futures markets, we're seeing oil trading back down in the high 70s within 12 months. Do you think that that is reasonable, and why?
Yes, good question to start off. First and foremost, of course, I would say that headlines are playing a very important role in determining what sort of prices you see, especially for 12-month, 18-month, 24-month strips. There's definitely a lot of optimism, especially whenever there's news around a potential deal in the making, a potential deal that is going to be signed, that's agreed upon. So there's that. We have to remember that we entered the year, this is since April of last year, OPEC has been releasing barrels onto the market. First, it was somewhere close to 500,000 per month. They did that for 4 consecutive months. Then I think they took a break, and then I think they started unwinding whatever remained of the 4 million barrels of production that they had cut sometime in 2024. So they had unwound all of that onto the market. in second, third, and fourth quarter of last year. And that even recently, they added close to 188,000 barrels per day just a couple of days ago.
So can we, to put that into perspective, because sometimes headlines will talk in terms of X million barrels, and it's difficult for people who are not in the energy industry to put that into context. Is that a lot? Is that a little? You mentioned 500,000 barrels a day. What does the global picture look like? How many barrels a day do we use globally, or annually, or monthly, whatever, however you want to break that down? How many do we use in the US so that people can put those numbers into context?
Yeah, I say just a number to sort of remember is that we use roughly around 104, 105 million barrels a day. Globally, I think the US number is probably close to 19 million barrels, give or take. I mean, this is again products demand. This is not like crude supply. Essentially, it's like products balances crude plus condensate plus NGLs plus everything else, refinery gains, biofuels. So this is everything included. We're talking about 104, roughly 20% of that in the US. So in that context, I mean, when OPEC is adding 4 million barrels over a period, I mean, they've not added of all four. They've somewhere close to 3.5 is what they've added. When they add that over the course of 8 months, and at the same time where you have the Brazil's growing, the Guyana's growing. I mean, Guyana has grown from almost nothing a few years ago to close to 1 million barrel of supply. So when all of these countries are growing, and then you add on top of that, there's that glut, that an oversupplied market, and that is why the prices were depressed. A large thanks for the market finding a floor goes to China, which is absorbing a lot of the oversupply and effectively building up their inventories. And that is also one of the fundamental reasons that they've been able to reduce their imports now, which is also sort of setting a ceiling in terms of how much prices rise. And of course, the US export is also helping. But the point, going back to your previous question, and that is the reason why you see that the futures curve is effectively depressed, or you'd say that it's around 75 versus 95 now. So that is the fundamental reason that the analysts in the oil and gas industry realize that there is an overhang. So as soon as those barrels are out of Strait of Hormuz, you need 6 to 8 weeks for flows to normalize. I think the overall supply picture would take about a couple of quarters to go back to normalcy. But then all that oil hits the market. And yes, we have been drawing down on strategic resources, commercial petroleum reserves. So we've been drawing down on that. So the market understands that, let's say we hit 1 billion barrel a week or 10 days ago in terms of how much the market has drawn down. So the market understands that it will take some weeks and months to fill that back, So the market has the capability to absorb, but that will stop at some point, and that is why you see that all those risks baked into those future curves.
So, and everyone, feel free to type some questions in the chat, because I don't want this just to be me. It's great to have some interaction here. But in the meantime, Aditya, what are your thoughts on the inflection points in this ongoing conflict? And you've got a lot of airline pilots on the call right now. And obviously, if oil stays in the $90, $100 a barrel range, that's really great for our investments, but it is not great for the airline industries. And what do you think the inflection points are, where if the conflict continues and the Strait of Hormuz is still struggling to get shipments through it in 2 weeks, 6 weeks, 6 months, like where does this become a real problem?
6 months, it's a massive problem. 6 weeks, I would still say it wouldn't be as massive a problem. I mean, yes, the optimism is the reason why the prompt market and the front month is not necessarily showing you what the real tightness is. There's a lot of refinery runs are being cut. There's in general, like stocks being drawn. The market essentially has enough to absorb at this point in time, and maybe they do for the next weeks, maybe 6 weeks, maybe 8 weeks. Again, it depends on what kind of responses you see on the demand side. Of course, there could be lower travel, there could be lower use of cars during summer driving months. So all of that could potentially help. A lot of flight cancellations essentially are happening. So all of this is helping demand destruction, which is also sort of helping us absorb this shock that the Hormuz closure has left. But if we thinking 6 months, then there has to be massive demand destruction and prices will definitely skyrocket. And you would definitely start to see a lot more investments being redirected into a lot of infill drilling. You'd see a lot more rigs being added in the US land, which will potentially be able to add maybe close to 500,000 to 1 million. I mean, these are theoretical numbers, but then you will start seeing significant movements in the market.
That reminds me of the quote that the cure for high oil prices is high oil prices, and the cure for low oil prices is low oil prices, right? Because it's a self-correcting market, because as prices are driven higher, more rigs come online, it incentivizes more drilling activity and more investment, which then increases supply, which depresses prices, and it's a self-correcting pendulum, right? So, but I do know that in the Middle East, the storage capacity is full or nearly full. Is that correct? And there's going to be some permanent damage that could occur to a lot of the oil wells in the Middle East if this conflict occurs, the storage fills up, and those wells are having to be capped. Is that correct?
Yes. So again, we what we've tried to do is again try to quantify this. That we basically look at individual wells in terms of age, what is the drive mechanism in terms of production recovery, and then in say a moderate case, if you shut in these wells for roughly a year, you could lose anywhere between 500,000 to 1.5 million barrels of permanent damage, meaning that the worst of the worst wells will never come back online. There will be a lot of factors that will impact it. Of course, there could be corrosion, there could be in general, wax formed at the bottom of the well, which will effectively reduce flows. So there could be a lot of physical damage that would effectively mean that we would lose somewhere between 500,000 to 1 million barrels. So there is that real loss. But going back to your point, yes, high prices add production, but that in effect, will effectively mean lower prices eventually. But in this context, especially with Strait of Hormuz and the fact that 20% of the global oil supplies come from there is no alternative to that. Of course, there's been discussion about, again, extending the west to east pipeline in UAE in parallel to ADCOP. There's also the Yanbu expansion or the east-west pipeline in Saudi. Also, there's discussions around expanding capacity for that. But these are potentially a strike or two away. All of it is sort of concentrated in Fujairah and for UAE. All of it is concentrated in Yanbu port in Saudi. A damage would potentially disrupt, again, oil supply significantly. So you're talking the order of maybe 8 to 10 million barrels in a world where Yanbu expands to maybe 7 million of regular flow and Fujairah to 3. In that world, you're talking about maybe 10 million barrel of supply at being risk as well. So the only way out is, of course, an agreement between Washington and Tehran. That's the only way out of this situation.
Right. TJ, you got anything you want to jump in with?
Yeah, if you don't mind. So in thinking about this investment, right, and the first 3 years being really the most important part for the wells that we're drilling this year into Q1 of next year, I guess what would be the scenario that would drive prices less than current future values? And just to stake it, we'll say $75. If U.S. or Washington and Tehran agreed, to something today, I guess how long would it be? And I know this is all speculative, but what are the conditions that would drive oil now below that $75 futures and even down, into like the 50s? Would it be massive drilling now, or would it be, the supply shock being absorbed, but would we find a new floor there? I'd be curious to know your thoughts.
So it depends on the kind of deal that is being signed between the two nations. It is a deal which is of complete resolution. Again, there are a lot of topics on the table. There's nuclear, there's tolling on Strait of Hormuz, there's damages, there's sanction reliefs, there is reparation funds, and there's a lot of topics on the table. So it depends on what kind of deal. In a world where you're talking about a full resolution, Strait of Hormuz back to normal, you'd still see some level of risk premium being baked into the prices, not necessarily because of anything to do with Middle East and the US, but more to do with the fact that we have drawn down close to 1 billion barrel. So the market will absorb. And if you think of a 3 million barrel per day a surplus supply, so effectively the market can absorb or will absorb all those extra barrels for at least 12 months, if not more, because that's the amount of barrels that's been wiped out. And a lot of it has come from reserves for different nations. And there might be also some strategic further filling up in light of the fact that now countries are aware, at least import-dependent nations are aware that this is a real risk. And maybe 120 days, maybe 160 days is not enough. Maybe we need to expand our storage to maybe 360 days. So there will be a lot of absorption in the market. But then beyond that, in 2020, let's say fourth quarter of 27, early 28 is when you'll start to see prices giving in. And then that could again trigger additional supply response either from OPEC, which has lost one of its key members very recently. So the effectiveness is also a big question, or somewhere else.
Yeah. So
Do you see
all things putting us in a pretty good position for our 2026 fund? I have to be honest, right? Yet to see how this unfolds. But TJ, what were you going to say?
Yeah, I guess it would really be, what would be the scenario that could drive those prices lower, in the sense of, if everybody realizes the cat's out of the bag, right? If Iran has the ability to hold Hormuz at will, if it happened once, it could potentially happen again. So that'll change everybody's risk matrix. And so therefore, do you guys see a world where people start drilling significantly more and that causes an oversupply issue? Or do you see, there always seems to be a little bit of the yin and yang there, but do you see that actually, I guess what I mean is the supply coming online being able to be mitigated by the price in a way that doesn't cause a crash?
I'd stick my neck out and say that the world has a short memory for these things. They would have soon moved on. 12 months of stable supplies, they would have moved on from it, and they wouldn't so they would look at prices and react and invest based on that, because ultimately they're answerable to investors. Like, no investor is going to tolerate a reason that, hey, by the way, I'm a certain XYZ E&P and I'm going to drill more because you remember Hormuz. That's not how it's going to work. So you would potentially not see a lot of additional drilling. And again, everyone realizes that we're not replacing Venezuela, which was producing 3 million at peak, exporting maybe close to 2.5 million. So we're effectively talking about 20% of global supplies. There's no replacement for that. So no matter how much you drill, you're not going to replace that, and that is not going to have an incentive. So of course, so keeping inventory there could be incentive for companies maintaining a very healthy inventory for exactly this reason, but not enough reason for them to double down on investments and think that this is a potential crisis that could loom on us and we could lose these barrels. So let's drill. Else you would have seen a lot more companies interested in Venezuela. Going back to China's discussion, you would see a lot more activity already happening, but there is that awareness that this will go back to normal because it's just too big a problem that has to solve itself some one way or the other. And that is why then a narrow deal is effectively what we also assume to be our base case, wherein both parties claim some form of victory, some form of objective achieved, and then we move from there.
Awesome. Thank you.
Thank you. Well, for anybody who is on live, please feel free to type a question in the chat, and would love to get to those. And if there aren't any questions, then Aditya, we can give you a little bit more time back on your calendar, and we'll take this in-house.
Yeah, absolutely. Just wait maybe 30 seconds or more. But if you want, you can share my email ID, and I would be happy to take any questions. And if there's anything that's particularly of interest to anyone, definitely happy to have a one-on-one at any other point.
Thank you so much.
Hey, do you mind if I ask one more?
Please.
In thinking about these questions, it's really like, okay, what could cause this deal to go sideways, right? So what could drive oil prices to be very, very low during the peak 3 years of this fund's performance? But on the flip side, what, Aditya, like, what are some of the worst case scenarios? I know we kind of talked about that at the beginning, but as far as prices go, is that a fair question, Tait? And you can cut me off.
No, yeah. Just I think we kind of talked about the fact that even if everything went back to normal today, that it would be a little bit of a long road back to normal. When you're saying, TJ, when you're saying, what about the flip side of a quote worst case scenario, you're talking about if the conflict drags on and prices stay elevated?
Yeah, exactly. For, let's say 6 months plus, I guess what does that turn into for the global supply?
Okay, in that case, if then there would be a lot of demand destruction, you'd see, again, flying would become extremely expensive. That would mean that there would be lower number of flights, maybe just in general, gas prices at the pumps would be significantly expensive. Inflation would skyrocket because, again, all of this trickles into diesel, that trickles into food, that's basically going to be massive. Would effectively mean lower consumption and effectively demand destruction to a certain degree. But that international pressure you'd start seeing a lot more military action support. It's effectively creating like some form of convoy in the Strait of Hormuz to get the oil out, but something dramatic will start happening because, again, the pressure would be massive and the governments would be pressured to basically get this oil out of the Strait of Hormuz. So it will still remain elevated. Doesn't mean that, because again, it does not necessarily mean a normal flow. It would mean that there's some form of restraint, or effectively that it's not stable flows. So there would be some ebbs and flows effectively, and the prices would still remain significantly elevated for the foreseeable future. So there's no, yeah. Because again, there's everybody fighting for those battles, and you're basically taking strategic decisions as governments as to what sort of COVID type of lockdown measures or demand restriction measures that you can apply. So you'd basically be pulling on a lot of different strategic decisions. Just because we have a couple of minutes, I know that there's a few questions.
Joshua's might be the most relevant to your current point, which is, what price of oil ends up causing a recession? I know you're not, an economist, so to speak, so that might be tough to speak to, but where do you see this tipping into? Obviously, this is causing pressure on the Fed to raise interest rates because this feeds into the CPI and inflation. What are your thoughts on that? How long and how high do prices need to stay before it tips the general economy into a broader recession?
Again, as you said, I'm not an economist, but I would think that a couple of quarters like this, and you'd start to see damaging effects in terms of recession. Yeah, so that of course, like large economies are already stalling in terms of so growth percentages are being revised down consistently for many of the large emerging economies. So you'd only see more and more of that in general. There's one that I see, like, how do you see the filling of SPR affecting global supply and pricing? But just to reiterate the message, I think if things were to go back to normal, then again, we think that there will still be, so Hormuz flows will maybe not be back, will not be back to normal. They'll still be leveraging a lot of Fujairah and Yanbu, both UAE and Saudi, in terms of export points for them. We see that at least for the next 12 to 18 months, the market has the capacity to absorb and refill and keep prices elevated. So until end of 27, maybe fourth quarter 27 is when you'll start to see prices starting to give in. But again, that's a hypothesis that market will absorb all this oversupply for the foreseeable future.
Thank you.
Yeah, there's a question around, this on LNG and natural gas, essentially in the form of LNG being shipped to Europe. One interesting, again, that's also very interesting market. There's a lot of leveraging of coal for power generation. Just in generally, like countries are somehow managing. That has a long-term impact as well. Of course, there's other alternatives. I mean, if it lasts forever, then of course you'd start incentivizing renewables. In the short term, of course, it'll be going back to traditional energy in form of coal. And of course, if there's any other domestic hydro generation, that will also be maximized. But what's one of the interesting things is, again, there's a lot of questions I haven't seen in this group, but around export bans. Because again, with midterms approaching, what do potential export bans look like? And again, a very quick one on that is that is again one catastrophic decision if that is to be made, because again, US taking off whatever they're exporting close to 5.5, 6 million barrels. It's now peaking at closer to 6 million barrels now, and that's largely driven not just by, again, but it's driven by SPR release largely. So if that's taken off the market, then you're effectively looking at WTI crashing by maybe $30, and you're seeing Brent rise by that same amount. The spread goes to $60 or more. And then that effectively means that you'd start seeing shut-ins in the US. So again, it could be a catastrophic decision. And the thing is, and the point that it could impact prices at the pump is not uniform. So East and West Coast, which effectively do import products, and Gulf Coast exporting, so PAT 3 exporting products, and PAT 1 and PAT 5 effectively importing products, would mean that the prices that pumps on the East and West Coast would still remain elevated, but in Gulf Coast would be significantly depressed. So it's one of those questions that we've been asked, like, what about an export ban? And we don't think that's a bad
idea. Interesting. Well, hopefully that message gets through to the politicians. I can't see that actually taking place with folks like yourself who are obviously very educated on the subject, and hopefully this information is flowing up the chain to those people who are making the decisions.
Yes, that's the little effort that there's a little contribution from Rystad to in general. So we're just putting these notes out and sharing it with everyone that we think would find it relevant in terms, and backing it with data, and that to effectively help them make educated decisions.
Excellent. Well, this has been a blast. Thank you for coming on. Thank you for your time, Aditya. For anybody that would like to get directly in touch with you, just reach out to us, investors@turbinecap.com, and we can connect you directly. But thank you again for coming on. This has been wonderful.
Thanks so much for having us. Bye-bye.
See ya.